Hello and welcome to the African Allocator Podcast. I'm your host, Chipo Muwowo. My guest today is Steven Quattry, Portfolio Manager at Morgan Stanley Investment Management. Steven, great having the podcast. Thanks so much for joining me.
Thanks, Chipo. We're really happy to be here.
Yeah, no, great to have you. Thank you. I'd love to just hear a little bit about your journey into investment management. So before we talk about, what you and your team are up to, investing across different markets, I'd love to hear a little bit about your story. So, what got you into this industry and, to Morgan Stanley?
Yeah, so essentially, I think there's a lot of people in the investment industry that you hear these stories of sort of investing in stocks at a very young age. I'm a little different in that I was always really curious about these bigger picture questions. So at a young age, I was always quite interested in like astronomy and religion. And so I've always sort of like lived in the clouds a bit. And I think that's kind of what's drawn me to, kind of more of the top-down macro type of investing. I went in university, I studied philosophy and finance, and I eventually got a job in finance. And after 2 years, when it was time for me to think about next steps, I knew I wanted to go to graduate school. And I had this misunderstanding of what an MBA was. I assumed it was all sort of accounting and financial statement analysis. And so I decided if I'm going to pay for grad school, I'd like to do something much more aligned in my interest in kind of bigger picture questions. So I studied international affairs, and there it was very multidisciplinary. So it's a lot of econ, statistics, political science, but also investing. And so I went to a program for 2 years. After that, worked at a hedge fund for 2 years, doing global macro with an emerging markets focus. And then in 2011, I joined Morgan Stanley. And so I've been here for almost 15 years on the emerging markets equity team. So again, I think our team here is still one that very much lives in the kind of legacy of Barton Biggs, the great macro investor who kind of founded the team. And so we're very much top down, and we marry that with a bottom up stock selection process, which I'm happy to talk to. But that's kind of my very long winded journey into the industry.
Yeah, no, fantastic. Thanks for sharing. Now, you manage the Morgan Stanley Investment Management Next Gen Emerging Markets Fund. I'm curious to hear about the vision and strategy behind the fund.
Yeah, I think with the fund, what we're really trying to do is to go back to that sort of original promise of what investing in emerging markets was always supposed to be. And, if you go back to the late 80s or early 90s, you'll sort of find the language used, the justifications used were a few things. One, it was, let's invest in these very large markets that have great growth prospects, attractive valuations, but I think most importantly that were overlooked and therefore uncorrelated. And so if you sort of empirically study the returns of emerging market equities, they in fact had their best risk-adjusted returns in the earlier years when they were, much more uncorrelated to global assets. And so I think that's what we're really trying to do with this fund. There are a number of really interesting investment opportunities in the current mainstream emerging markets. Plenty of opportunities in China and India, but I don't know that they're necessarily overlooked. I don't know that they're necessarily uncorrelated, but they can be great opportunities. So for people looking for that, that's one option. I think what we're trying to do is say, look, if you do want a much more uncorrelated asset class at the expense that something is maybe a slightly more illiquid, then that's what we're trying to do here. So in short, we're looking for large countries which are overlooked, uncorrelated, and growing quite fast. And there, I can give you kind of the specific countries we're looking into if possible.
Yeah.
But
Actually, I'd love to hear more about that. What kind of countries, sectors do you typically focus on?
Yeah, so the way I like to phrase it is that there is 195 countries in the world today, right? But there is this sort of exclusive club of only 15 that belong to like what I'd call the 100 million population club. And most of these countries are sort of well covered by investors. So you can think the United States, China, India, et cetera. But Of these 15, more than half of them essentially have no allocation by global equity investors. And so these are the countries where we really try and focus because they're large and very much overlooked. So those would be Vietnam, Indonesia, Philippines, Pakistan, Bangladesh, Egypt, Ethiopia, and Nigeria. These countries combine for about 1.3 billion people, and yet global equity allocators have just 1/3 of 1% to these countries. So it's essentially akin to their allocations to Finland. So we think that probably will not continue over time. What's more importantly, as I was sort of alluding to earlier, is that these countries are growing quite fast. They're growing much faster than most mainstream emerging markets, and certainly faster than the rest of the world. They have great demographics. So while demographics are quite a mixed bag in the advanced economies and even in some emerging markets, and these 7 countries, they're over the next decade adding about 130 million new people to their labor forces. You can think of it as sort of adding a Mexico over the next decade. And again, like, they are uncorrelated. So they're uncorrelated to global equity indices. They're uncorrelated to emerging markets, and they're uncorrelated to each other. So, I think these are the markets where I'd say at least 2/3 of our portfolio are focused. There's, I'd say, a number of really interesting themes that we invest in these markets. Just very quickly, in terms of the sectors, I think my sort of circle of competence is one that is very much comfortable in the consumer space. So we do a lot of investing in discretionary consumer staples, and then also some of these sort of technology focused companies, whether in e-commerce or super apps or even IT service providers. We don't do a lot of cyclical business investing. Frankly, I'm not very good at timing a lot of these opportunities. So, yeah, that's kind of where we think our sweet spot is for the moment.
Yeah. I just want to go back to something you said earlier. Your approach is a sort of top-down, approach, but you obviously do bottom-up work as well. Could you just sort of tease that out a little bit more? Just give me a sense of what that looks like. So, take a country, say Vietnam. Are you looking at the big macro indicators first before you start looking at the businesses, or how does that work in reality?
Yeah, absolutely. We are very much kind of focused on the top down. So it's sort of a 2-part investment approach. So it's one, should we be allocating capital to this country? Yes or no, increasing, decreasing. And then number 2, if we decide to, which companies do we think we should be investing in? Which are the kind of great kind of quality companies that kind of best express that. So, there is the macroeconomic question is very important. And there's a number of countries that we have been avoiding for a few years because we've kind of felt that the macroeconomic adjustments was not complete, with respect to currencies and growth. And so we will be patient and kind of wait until we think things are ripe for us to enter that market. So, the macro is a big function of our investment process. It's, growth. Where do we think growth is going? Inflation, interest rates. But we're really more, given our time period of maybe 2 to 3 years, we're really focused on kind of the more structural issues. Do we see a risk of sort of currency returns being quite negative in the near term? So to answer your question, it's a bit of a 2-part one, but macro is certainly a really big component for us.
One of the common objections I hear from particularly, sort of Western investors looking at, certain emerging markets is, liquidity within these markets. You just said, your time horizon is 2 to 3 years. I'm kind of curious how that sits with liquidity management. Maybe actually markets you're focused on don't have deep liquidity issues. So how do those 2 things sit together?
Yeah. So we are very cognizant and aware of liquidity. Just from a risk management standpoint, we need to make sure that there are exit opportunities when we invest in some of these countries and companies. So it's something we're aware of, and it's basically a function of our fund size and with respect to an average position size, how long it will take us to buy into that company. We want to make sure we're not moving the price too much from our entry price. And then as we exit, we want to make sure that we can exit in a fairly timely fashion. So liquidity is important. The only thing that I would say, though, with respect to the asset class, is that yes, this is, a lot of the markets that we are focused on are illiquid, but I think there's a lot that you get in exchange for that low liquidity that you cannot get from other asset classes. One is simply valuations. I think illiquid markets tend to trade at much lower valuations, and these markets are no exception. Two, something we were discussing earlier, the correlations. So if a market is illiquid, it tends not to be too correlated to other global markets. Three, you get much fewer people sort of kicking the tires in illiquid markets. So I like to point out that the average stock in the S&P has about 24 analysts per stock. In emerging markets, the MSCI EM index, the average is not too different. It's 19 analysts. But in the sort of frontier index where we do a lot of our work, it's just 4. So it's basically like 1/5 the number of people kicking the tires. So I think that's important. And then maybe just, one last thing about liquidity, which I like to point out too, is that if you go back to India in the early 2000s, I think it was about 2002, that market was trading, the Sensex was trading just $140 million a day in terms of liquidity. That's about what Pakistan trades today. It's about what the Philippines trades today. So that has now risen quite extensively. And over that period, the Indian market itself has gone from about $130 billion to over $5 trillion. And so the point here is that sometimes it pays to be early in these kind of low liquidity markets. Certainly a lot of other things need to go right in order for that liquidity to improve. But I don't think low liquidity necessarily in and of itself should sort of preclude people from looking at some of these markets.
Mm-hmm. I want to talk about Africa now. From my research, I think most of your exposure is in Asia, but you do have some Africa exposure. Tell me more about some of the countries you're invested in, sectors.
Yeah. So Africa, I think as a whole, is about 15% of our fund. We're invested in Nigeria, Egypt, Kenya, and then we have some sort of Pan-African country plays as well. This 15% is up materially. It was closer to zero as recently as a few years ago, and so the question is sort of what's changed and why. And I think there's a number of countries in Africa that had sort of fallen victim to countries throughout the world, which was that the external shocks had really had a huge impact. So if you think COVID-19 hitting tourism and raising inflation, some of these geopolitical conflicts, increasing import prices, increasing, and therefore, worsening the external balances. You've got high global interest rates, the strong dollar, and so what happens is if you have these sort of, vulnerable countries which were running unorthodox policies, think high fiscal deficit, high current account deficit, overvalued currencies. When that's kind of met with these external shocks, you get a bad outcome. And by 2022, I think we had essentially the highest share of countries facing sovereign distress in about 25 years. You had currency devaluations of anywhere between 45 and 80%. But the point is that a lot of times these crises can create compelling opportunities from the investment standpoint. And what we've seen is that a number of countries did devalue their currencies. They have now adopted much more orthodox economic policies, more focused on reform. And with equity valuations trading at historical lows due to some of the shocks I mentioned, we said it's time to sort of start doing our homework. And so I think we did enter Africa in a pretty big extent a few years back. As far as exact sectors, we're probably not too different from some other funds in that we do have a focus on the financials first and foremost. So I can give you an example of, there's some very high quality financial institutions across Africa that had seen their market caps decline massively. One in particular, I think it was about $5 billion that had fallen all the way to 700 million. They have a great track record in terms of ROEs, simply because they have the strongest, deposit franchise in their given countries, leading to high, NIMs via low cost of funding. The valuations had gotten extreme. So I think on a particular company, if memory serves me, the market cap was trading at something like 1.7 times pre-provision operating profits. So the whole market cap was 1.7 times, pre-provision operating profits. And so that kind of gave us a margin of safety where we felt like, okay, we feel comfortable kind of, investing here. Then maybe just two other quick sectors. One is about a year or two ago, for various reasons, we were looking to add some exposure to gold. There are some, African-focused gold mining companies with operations on the continent, trading with no debt on the balance sheet, really strong free cash flow generation, yet trading at huge kind of African discounts, PEs of 6 times versus peers of about 18 times. So we did add some exposure there. And then finally, this just whole digitization idea, whether it's telcos or banks or other kind of fintech companies, clearly this is a pretty high growth opportunity, 20 to 30%, with high returns on invested capital and very asset light approach. And we think there's a pretty good runway. So yeah, that's our exposure. Those are some of the sectors we're focused on the continent.
Mm-hmm. Are you looking to increase that over the next few years, or are you just sort of holding steady for now?
We have been looking to increase it. Liquidity is a bit of an issue, unfortunately, but I think all of the signs are pointing in a positive way, such that if we are able to increase our exposure, I think we certainly would look to do that.
One country that's undertaken some significant reforms is Nigeria. Obviously, they, had a new president come in 2023, and you wrote a piece, I think, in August that year, called Nigeria's New Dawn, and you're effectively making the case, for why investors should look at Nigeria, why they should take it seriously. Can you, sort of share one or two key things in your minds that people should think about when they think of Nigeria? Why should they take it seriously as a market?
Yeah, sure. I mean, I'll start out with the obvious, but that maybe the foreign investors who don't look on the continent would know. But Nigeria is large, it's young, and it's growing. And so, the population of 220 million people with a median age of under 17 years old, it's just this sort of massive, youthful market. I think it's expected to add about 38 million people to the labor force over the next decade, second only to India. And that should support long-term consumption growth. I think the real catalyst, though, is something you mentioned, which is sort of a fresh start, post stagnation. So, under the previous administration in Nigeria prior to 2023, it was just a very very bad outcome, and it's unfortunately there's a huge human tolls to this. So, I think income levels during the reign of the previous administration, if you look at, say, Kenya, over those 8 years, GDP per capita or income levels rose 40%. Rwanda income levels rose about 30%. Egypt saw incomes rise about 20%. But in Nigeria, they declined by 30%. And it's large increases in extreme poverty. But the new president has started to unwind some of these kind of destructive policies, whether it's kind of, removing the fuel subsidies, currency controls, and really starting to do, some reform. And so I think that is what got us, quite excited at the start. And I think, something that I'm a big believer of, and I know I'm not alone here, but I think it's unappreciated maybe by foreign investors. It's just that, in Nigeria, the greatest asset is human capital. It's not natural resources. And you can certainly just look to, the outcomes of Nigerians as they assimilate into other countries. You can sort of look to that. And I think that this human capital is not being, properly utilized in the country. So I think one thing I like to always point to is that there's about 125 million English speakers in Nigeria. It's more than the US. Sorry, it's more than the UK, Canada, and Australia combined. But there was never any sort of like a BPO business process outsourcing sector, and that I always felt was a huge missed opportunity. To give you a number, in the Philippines, the BPO sector drew in $35 billion a year. So I just think that hopefully with this new administration, I think focusing on education, bridging the gap in outcomes between the North and the South will be key. But hey, what better opportunity to use that $10 billion in subsidy savings than to put it towards that? And I'll just end with like a quote that I love from the founder of Infosys. He says, look, when people travel to emerging markets, when they travel to countries like India or Nigeria, they often just see the problem of, a billion hungry mouths, but they don't miss the potential of the billions of minds. And I think that when it comes to Nigeria, the new administration's real challenge is to, unleash that potential of Nigeria's human capital. I think the reforms are a positive step, but there probably a little bit more needs to be done on the human capital side to really help the country grow.
We talked about, the sort of macro top-down approach that you take. I'm curious to hear, when you're looking at individual stocks, as you're doing research and stuff, what do you look for in companies? Yeah. So what's your stock picking approach, and what key principles guide that process?
Yeah. If I were to summarize it in one phrase, we're looking for outstanding businesses in overlooked markets. And so what does that mean? So we are growth investors. So we are looking for sort of secular growth opportunities first and foremost. As far as characteristics, we do have a real emphasis on quality. So we're looking for high quality companies, those that are able to generate really high returns on invested capital, first and foremost. Secondly, we want those companies to have a sustainable competitive advantage in order to sort of protect those high returns over time. And then we want to acquire these businesses at reasonable prices. So we're looking for companies that are trading at a sort of intrinsic discount to what we think they're worth. And so I think that kind of underlies what we're really looking for when we're analyzing companies.
And what are some key red flags that you're looking out for as well?
Yeah, I think first and foremost, it's the macroeconomic landscape. I think that's really key. I think again, it's unappreciated by some folks who just do bottom up. And I think if I were to point folks on where to at least look on the macro, I kind of cut my teeth looking at the balance of payments. Studying the history of financial distress in emerging markets. So I think focusing on the balance of payments is key. So I look extensively there when I look at the country level. At the company level, if I were to kind of give some broad generalizations, I'd say, we look for humble management teams. I worry when management starts to talk about certain like earnings streaks, for the 8th straight quarter, we've grown top line at X, because that often leads to incentives to keep these streaks alive. Number one. Number two, I think we're constantly sort of geeking out about this competitive advantage, and we want to make sure that their strategy is sort of fully taking advantage of a company's competitive advantage. To give you an example, let's say a theoretical company has this amazing brand. They've built it up for 50 years on some consumer product. And when you ask them, well, what's your strategy going forward? They say, we're going to start exporting to a different country. And you'll notice that, well, the brand awareness you've built up doesn't apply to a new country necessarily. And so I think that's an example where the strategy is not aligned with the competitive advantage if it is a brand in this case. So I kind of, that's a red flag for me. And then, maybe just related, I'd say business model creep. So, what you'll see a lot of times is a company with a great strength and advantage in one industry starts to acquire or grow assets in a sector which doesn't have any real adjacencies to what they're good at, and so that's another red flag for me.
Yeah, that's interesting. From an African perspective, I know that the sort of activist investor approach isn't very common. At least if you compare it to the US. But when you see red flags like that, typically are you trying to communicate this to management, or is it let's leave it for now? Or what typically what do you do?
Yeah, we're very fortunate to often be able to speak with management. I mean, I should have said at the start that we never invest in a company unless we're first able to speak with the management team. So there's a lot of the due diligence that goes on behind the scenes, and when we feel like we have a strong thesis in place, our questions in order, we'll look to set up a call with the management team. And then if it is the case that one of our investments, we feel like there is one of these red flags we talked about, or we feel like the strategy is kind of going in a direction that we didn't expect, we will certainly communicate that to management teams. And I think like there can be different outcomes because of that, right? Sometimes one as an investor can be convinced as to why they're right and you're wrong. Maybe there's something that I didn't quite appreciate, and I learn and we move forward. And other times there's a bit of a disagreement, and we will agree to disagree, and we may very well end our investment in the company at that stage. But we are always able to, fortunately, be on a platform where we're able to kind of speak with management teams and kind of voice how we're thinking about things.
Now, you just returned from a trip to Central Asia. I'm curious to hear, what are your observations around similarities, differences between those sort of more frontier Asian markets and African markets?
Yeah. So, I was just in Central Asia 2 weeks ago, and I was in Uzbekistan and Kazakhstan, and then on to Georgia. And I think in terms of similarities with maybe some countries in Africa, first is they're all overlooked. Many of them are trading at very cheap valuations, but they're home to great businesses and they're high growth countries. And I think there's a theme that we've been really focused on, and which is that as superpowers clash, middle powers rise. And so what I mean by that is that investors are really focused on this kind of as a geopolitical clash between the US and China. But there's a number of what we would call middle powers. These are sort of strategically important, regionally important countries that are very large. And what they're often doing is they're leveraging these tensions between superpowers in order to sort of secure foreign capital, and they use that to expand their infrastructure. I think that is very clearly happening in Central Asia, and I think it's happening in Africa too. And maybe to give you the example for Central Asia, in case your audience isn't aware, but I was going to Uzbekistan, and I did get a lot of kind of questions from friends and colleagues of why are you going to one of these like stand countries, and I think I started when you land at the airport at 4 a.m. and you walk out and you see a neon sign that's promoting digital banking. I think it starts to become clear that this isn't really what people's perception is. So to take just Uzbekistan, it's a very large country. It's a country of 40 million people. It's basically the same size as Poland or Canada in terms of population. Second, it's growing very fast. So since 2010, it's been growing faster than Vietnam and faster than India even. Why is that? Because it was once a landlocked, it is a landlocked state, but it's rapidly reforming. It's privatizing assets. It's rolling out tax incentives. And the key is that it's attracting FDI. So FDI has quadrupled to about $12 billion. And that's fueling this infrastructure projects from railways to Trans-Caspian pipelines. And so I think, it's a country that is landlocked, but now it's sort of land linked with this infrastructure development. And, I think it's not just physical infrastructure. The digital infrastructure is growing rapidly as well. To give you one stat, there is a digital bank that is a listed company, and their loan book was about $30 million in 2021. It's going to hit $1 billion this year. So that's a 20x in a few short years. And so, I think what the commonalities are overlooked cheap valuations of 2 to 4 times PEs in Uzbekistan. And again, I think that both across Africa and in Central Asia, you're seeing this infrastructure build out using capital from some of the superpowers. So very, very interesting place I think people are overlooking.
I've got a final question. As you look ahead, over the next 12 to 18 months, what key data are you keeping an eye on? So economic data, investment industry data. What are you keeping your eye on?
Yeah, I think maybe I'll make 2 points. One is that I think that the U.S. administration has sort of tried to make America great, but I think that in fact the rest of the world is actually getting better instead. I think the real sort of exceptionalism today is probably in international and emerging markets. You're seeing a number of countries sort of wake up and finally start to address some structural issues for better or for worse. I can point to that when I was in Vietnam. I think the country a few weeks ago, the country realizes that they can no longer rely on low margin exports, and they're really now focusing on the private sector in a way that they haven't done in the last 40 years. Clearly examples in Germany increasing spending. And I think even for the continent of Africa, you're seeing intellectuals and governments start to have hard questions about how do we grow without a reliance on foreign aid. And it's certainly not a great outcome, but if there is a positive light, it's that they're starting to address some of these structural issues. And then I just say the second thing I'm focused on is just earnings growth. And I think this is an important point to make when it comes to markets in Africa and across emerging markets. And that is that, despite noisy politics, despite noisy economic cycles, don't forget that these are home to outstanding businesses that have learned to adapt to this. And I'll give you a statistic that is maybe quite shocking, but since 2011, when we get really good earnings data across all these different countries, a period which includes this U.S. tech cycle, the dollar earnings growth in Nigeria has been since 2011 67% in dollar terms. That's been faster than in India. It's been faster than the Sensex index in India, which has grown just about 40%. A country like Egypt over that period has grown their dollar earnings by about 19%. That's faster than MSCI Emerging Markets Index. And so the point here is that there's a lot of volatility, but if you focus on earnings, again, in dollar terms, many of these countries are home to companies that have adapted, that are able to generate earnings. And at some point, the multiple people are willing to pay for that earnings will probably come back in line with what it should be. I mean, probably should not be trading at low single-digit PE multiples. So I'm really focused on dollar earnings growth.
Fantastic. Steven, that's a great place to stop. I really appreciate you talking to me today. Some really interesting stuff there. Thank you for coming on the podcast, and have a good day. Thank you.
Thanks, Chipo. Appreciate your time, and I love what you're doing, and keep up the great work.
Thank you.